Hello, my name is Alyssa Galina, and I'm joined by my classmate Cody Perez to welcome you to the 6th Annual Titans of Real Estate, hosted jointly by the Baker Program in Real Estate and the School of Hotel Administration's Center for Real Estate Finance. I am a second-year student in the Baker Program, the 2-year comprehensive Master's in Real Estate program here at Cornell, while Cody is a second-year dual degree student, enrolled in both the Baker Program and the Johnson School MBA. Today's event is featuring an interview with this year's Titan of Real Estate, Brian Kingston, Managing Partner and CEO of Real Estate of Brookfield Property Partners, moderated by Richard Baker, Governor and CEO of Hudson's Bay Company. Following the interview, we will open the floor for questions and invite you to submit them in the chat during the event. Next, I would like to welcome Dean Andrew Crowley, who will introduce our distinguished guests. Andrew Crowley is Professor of Finance and holder of the Harold Berman Jr. Distinguished Professorship in Management at the Cornell S.C. Johnson College of Business. He currently serves as Acting Dean and Dean of Academic Affairs for the college, joining Cornell in 2009. Without further ado, Dean Andrew Crowley.
Thank you, Alyssa and Cody. Hello, everybody. Welcome to the 2021 Titans of Real Estate event. We're gathering to honor Brian Kingston, CEO of Brookfield Property Partners Real Estate. We're incredibly grateful to the generous support of the Cornell Real Estate Council, alumnus Paul Rubaka, and JLL Jones Lang LaSalle. We thank you all so much for your sponsorship and for supporting real estate at Cornell. As you all know, this Titans event has emerged as a signature one for the School of Hotel Administration and the Center for Real Estate and Finance and the Baker Program for Real Estate in the short 6 years since it was launched. The past programs have featured some luminaries in the real estate field speaking on a wide range of topics related to mixed-use properties and development, the use of blockchain technology via smart contracts and distributed ledgers to facilitate renting, buying, investing, and lending decisions. Always the topics are the eyes and ears on the global trends in the real estate industry. This past year, we've clearly experienced the impact of COVID-19 in the global economy, and the commercial real estate industry, which is our topic of the hour, has refocused attention on the importance of digitizing operations, the need to close certain kinds of physical facilities due to lockdowns, to prepare for reopenings, while ensuring health and safety of employees and occupiers, not to mention just the overall financial health of tenants and users. I just read this weekend in preparation for today a Deloitte 2021 Commercial Real Estate Outlook report that surveyed, 200 industry leaders that pointed out that only about 1/3 of them agree or strongly agree that they feel they have the resources and skills to operate in a digitally transformed business. Less than 50% consider digital tenant experience a core competency of their business. And most, I think it was 56%, believe that the pandemic this past year has really uncovered some of those key shortcomings in their digital capabilities. Among those answers, the focus was significant focus was on cybersecurity and data privacy concerns. It seems that the pandemic is creating longer-term sort of evolving shifts in tenant and end-user preferences that are sort of influencing leasing demands. Now, I share all of these reflections on the Deloitte Outlook, not because I find them real eye-openers for a mission-critical industry like real estate, although they clearly are fascinating statistics, but mostly because I know that we at Cornell and at the School of Hotel Administration, at the Center for Real Estate and Finance and the Baker Program, we lead on tough issues of the day. We don't shy away, and we tackle them head on. These issues that I've described to you matter to our faculty. They inform our research and our teaching programs. They've been front and center, honestly, front and center on numerous webinars, virtual roundtables, eCornell panels organized by CREF, the Center for Hospitality Research. I am really proud of how our colleagues have stepped up in a big way when the industry needs us the most. And that, I think, is why it's so important for us to gather for this Titans of Real Estate event like we do today. So I'm going to hand over to Richard Baker, who's going to be our moderator and host for today and interviewing Brian Kingston, our Titan of the day. But I would be remiss if I didn't thank out of the gate Steve Carvel, who's the director of CREF, the Center for Real Estate Finance, Daniel Lebre, who directs the Baker program, and really a shout out to all of our top flight real estate scholars at Cornell, Dan Kwan, Peter Liu, Crocker Liu, Eva Steiner, and our newest hires, Alexei Chisti and Dragana Sivanovic. This is a truly powerhouse group. We can compete with the very best real estate faculty in the country. And of course, you have to thank students like Cody and Alyssa, many students in the Baker program who've really stepped up to volunteer on events like today. And of course, Liz Cunningham, without whose hard work, none of this would be possible. I really want to thank all of you. So ladies and gentlemen, Richard Baker, he is known to many, many of us. He is the governor, executive chair, and CEO of HBC, Hudson's Bay Company. It's a holding and investment company of distinct North American retail and real estate operating businesses. Hudson's Bay, Saks Fifth Avenue, Saks off Fifth, HBC Property and Investments. He's the executive chair of each of the operating companies inside the HBC family. Honestly, Richard's been instrumental in leading the company's long-term growth strategy, including notably taking the company private last year in March 2020. He has a strong track record of completing value-enhancing transactions that have transformed HBC over the last decade. Of course, we must note that Richard is on the Board of Trustees at Cornell University. He's served or is currently serving on university councils and boards, including the Baker program, in the Real Estate Advisory Board, the School of Hotel Administration Advisory Council, as well as the CREF Advisory Board. Richard, we are so, so grateful for all of your ongoing support. And the guest of honor is Brian Kingston, Managing Partner and Chief Executive Officer at Brookfield Real Estate Group and Brookfield Property Partners. He joined Brookfield in 2001. He was named CEO of Brookfield Property Partners in 2015. He has a long career going all the way back with Brookfield. And I want to note that Brian is a distinguished graduate of the now Smith School of Business at Queen's University, a university partner of our Cornell S.C. Johnson College of Business. So I'm going to hand that over to you, Richard. Thank you, Brian. Thank you, Richard, for what's going to be, I think, a fantastic conversation.
Thank you, Andrew. That was a wonderful introduction. And thank you, Brian, for joining us. Brian and I are together here at Brookfield Place in Lower Manhattan, which is a spectacular venue. We tried to get the view to be behind us, but it was too bright. Brian and I are looking out right now on the Hudson River and the Statue of Liberty, which is right in front of us. And we're actually sitting in a new Skunk Works project that we call Saks Works. So I want to start, Brian, by letting you know that a large amount of the folks viewing us today are students. And I promise you a large percentage of them are scratching their head and wondering what road, how do you become the CEO of the world's largest real estate company? If it's not the world's largest, it's the second. I'm the CEO of the world's second oldest company, but that's fun. But being the CEO of the world's largest real estate company is interesting. Give the folks in the audience a little bit of background of where you came from and how you maneuvered your way to get that post.
Yeah, and I guess it's probably better to be the second largest. Like Hertz, we're number two. And, it sort of keeps you working hard, I think. As Andrew mentioned, I graduated from Queens in sort of the late '90s, and I really didn't at the time didn't really have a clear idea of what I wanted to do.
Canada,
Queens,
right?
Yeah, sorry, yes, exactly, not New York.
You're a Canadian citizen.
Right. So the little school outside of Toronto wasn't entirely clear. A lot of my friends were going into investment banking, with ultimately a plan to go back and do graduate school, et cetera. And, when I first started my business degree, I thought one thing I'm definitely not going to do with it is accounting. Accounting was boring. It was one thing I wasn't going to do. By the time I got to the end of my degree, I was heading to Ernst & Young to become a chartered accountant, and it was amazing, like a finishing school almost. So you come out of school and you've got all this knowledge.
1 year there, 2 years? How long?
I was at EY 2 years. Yeah, and but it was a really great environment to come out of school and get a wide-ranging look at a lot of different industries. And so I was working on everything from a duck hunting lodge up north of Toronto, auditing their books, to very large insurance companies, working on the banks, and they gave you this great view of different industries and a different taste for. Frankly, you're walking around a lot of different offices and seeing what's happening in buildings. So that was a great experience, and it just sort of it created almost an instant network of people. And so the real story of how I joined Brookfield was just dumb luck. Frankly, it was I knew somebody who knew somebody, and they were hiring. And it's
not how it usually happens.
It's usually, I think, so it's not. I guess the point of it is that there was no master plan, where you sit down, with this in mind, and nor do I think if you had a master plan, it would never have worked out. And I think the important thing is, when you're coming out to keep your head up, keep an eye out for opportunities, be open to different things, and don't kind of get yourself boxed in too early. Because at one point I thought I was going to do something in financial services. This opportunity came along. Frankly, even when I joined Brookfield, it wasn't exactly a real estate role that I was in. It was
so that was your second job.
Second job.
So what was this thing? Because Brookfield's morphed, and you guys have created something. What was it called, and what was it back then?
Yeah. So at the time, the company I actually joined was called Trilon, which was a merchant bank that sat underneath a company called Brascan. Brascan was a 100-year-old company. If there's any Canadians on it, it was ultimately taken control of in the 60s by an arm of the Bronfman family, and it really built itself into a conglomerate, a Canadian conglomerate. It owns everything from the Montreal Canadiens to Labatt's Brewery, trees, mining companies, insurance companies, and was quite a broad-based business. When I joined in 2000, we were in the process of narrowing the focus of that business to what it is today, which is really focused on real assets. So in addition to real estate, we've got large investments in infrastructure, private equity, and renewable energy. And then importantly, not only investing in just those four sectors, but evolving it into an asset manager where we brought in pension funds, sovereign wealth funds, et cetera, and manage their capital alongside our own.
So you just kept working your way up, like you literally came in 2 years out of college. Yeah. And worked your way all the way up through the system.
Yeah, and just as I said, it was sort of a lot of right place, right time, and I guess a lot of times you sort of create those opportunities by staying open to them.
Were you in real estate the whole time, or were you?
No, in fact, when I started, because I audited insurance companies. I was working on a couple of insurance company restructurings, and I can tell you the day I became a real estate guy, I happened to be in the office on a Sunday. Bruce Flatt, our CEO, came in and said, something going on with Canary Wharf. They've just come out with a big disclosure. I didn't know what Canary Wharf was, but this Canary Wharf, they had a big disclosure. The stock has dropped. We need to look at this. And they looked around the office, and there was one guy who looked up, and he said, "You get over here, and we need to build a financial model on this company." And that was sort of my baptism by fire in real estate. And then really just evolved from there. And so I worked on a number of transactions, including one we bought a company in Australia. And then a real estate company, once we bought that business, we needed somebody to move down there and actually run it. And so I kind of put my hand up. Not many people wanted to move to, even though in theory, moving to Australia seems like a great idea. The idea of actually uprooting your family and moving to the other side of the world, it wasn't a long list. And so I went down. It's a fantastic experience for 5 years down there. And then I moved here to New York in 2013.
So very interesting. So you were kind of a manager of real estate companies rather than a real estate guy who came up through the real estate ranks.
I've never read a lease in my life.
Yeah, that's very. Can you do that? That's very interesting. So you don't run across that often. So do us all a favor, because it's complicated for us. Explain the Brookfield structure. Spend 3 minutes on it, but explain the structure for us, because it's very unusual. It's very simple.
So, at the top of the of the chain is a company called Brookfield Asset Management. It's about a $60 billion market cap. It trades on Toronto and New York, large public company, lots of disclosure around there. That's the parent company. That's where I work. And think of it in a funds management context. It's the GP, the general partner of a series of funds. 4 public funds that sit underneath this, so publicly listed partnerships, one for real estate, one for infrastructure, one for private equity, and one for renewable energy. And then a whole series of private funds that have institutional investors in them. Some are closed-end, some are open-ended. And it's the manager of all of those funds, and all of those funds, including the public vehicles, pay fees up to the parent company. And so it has, a portion of its earnings that come from those fees, but it also has this $60 billion balance sheet that makes it a significant investor in all of those fund strategies. And so 25 to 30% of our earnings come from management fees, et cetera. The other 75% comes from our returns of investing in these various businesses.
So you can buy and sell and roll up, and so your main, so infrastructure, so the way you put it was infrastructure, real estate, and
renewable power, and MPE.
Okay. So now let's dive in, because it's a real estate story. So let's dive in here a little bit on real estate. So let's first talk about where are you deep in let's go office, residential, retail, and hotel. So tell us and then maybe let's take a cut at it and look at it globally. But let's start by category first.
Sure. In terms of where our business is, or what's going on?
So you're deep into office space. You're deep into certain kinds of retail. You're not in other kinds of. Give us a little diagnosis of that.
Yeah. So if you sort of dissect the types of funds and the types of investors we're trying to attract, our story to them is all the same. And whether it's real estate or infrastructure or any other businesses, it's the same thing, which is you have these very large pools of long-term capital out there, sovereign wealth funds, insurance companies, pension funds. And over the last 20 years, we have benefited, as I described that evolution in the business, we've benefited from a generally declining interest rate. Every year, their portfolio, and say my fixed income portfolio is not earning what I need it to earn, I need to take a portion of it and reallocate it to something else. And so
people are trading out of bonds to go into real estate.
Right. And it's an oversimplification, but 20 years ago, people would have been 60% equities, 40% bonds. Today they're probably 60% equity, 20% bonds, and 20% alternatives, they refer to them as. And that's really where we fit in, is providing that alternative. And so while they want a little bit of...
And that's the corporate stock. And so that pays a dividend.
And also, even the funds that we're investing, it's these pension funds are allocating more capital to something where they say, look, I have equity risk already. That's, I own public shares or I own other things, and that's quite volatile. It's all over the place. And I have really safe government bonds, et cetera, that are yielding almost nothing. I need something in between, which is it provides a steady, predictable yield, inflation protection, but not all the crazy volatility of investing, say, in the public markets. And that's really our sweet spot where we've come into, and we've benefited from a massive, and even though that doesn't sound like a lot, going from maybe 5 or 10% to 20%, this is on trillions of dollars globally. So there's been a huge wave of capital that's going into it. So the types of assets that we own we're not swinging for the fences. We're not buying, highly risky, big, ambitious, crazy development projects and hoping it's either going to be a 0 or a 40. They're safer, but it is, what we try to buy is things that are stable and predictable. And so office is a great example of that. These are huge assets. You can put a lot of capital to work in a relatively discrete investment size. The precinct we're sitting in here today, I can see $5 billion worth of real estate out of the window of our office. And so we really like office because it is so scalable. And so our office business is global. It's our largest business. It's New York, it's Toronto, it's London, it's Sydney, it's Shanghai, it's Berlin, major cities around the world, and sort of this Class A office space.
So for a moment, let's just stick with office for a second. So we got to talk about the pandemic, and we'll go by category. So just crazy year with the pandemic. How did your office hold up around the world? And then two-part question. And then where is your imagination? Where are you imagining that office is going? Is everyone going to work from home for the rest of the time, or?
Right. So
By country first.
First, looking backwards over the last 12 months, the portfolio we own is 93% leased, average remaining lease term of 8 or 9 years, predominantly let to financial services, governments, major technology companies. And so if you look
favorite retailer on occasion.
And a favorite retailer. And so if you look at it, for the most part, those businesses, their actual operations have held up well over the last 12 months. Accounting firms, law firms, banks, record earnings. And so even though they're not actually using their offices, we've got the corporate parent because of the size of these leases as a guarantor of them, they continue paying the rent throughout. So our collections within our business throughout the period have been completely normal. What's been abnormal is new leasing, right? So if we have any vacant space, there's nobody out leasing new space over the past.
New leasing in U.S. or global office came to a screeching halt.
Right, a year ago.
Right.
Now, in some places, using Asia as a good example of sort of, I'll say, the earliest ones to emerge from this, by about September of last year, it returned to normal. We're back out leasing again. Everybody, utilization within the office was 80 to 90%, which is normal. Like you never have 100% of the people in on a given day. So they were back to normal. Leasing has been strong there, and it has continued.
So all this talk, which we could discuss in the U.S. about the new normal, how people are going to work, if Asia is any indication, the new normal is the old normal.
Not just Asia. So Asia for sure. Then we started to see it in Europe, same thing. So if you look in UK now technically, I guess, isn't Europe anymore, right. So we can talk about it separately, but certainly within continental Europe as well. When Italy reopened, everybody was back in the office. When Spain reopened, everybody was back in the office. Now, did they think a little bit about what their long-term strategy might be? Absolutely. And that's when I think it starts to get interesting. If you look, I'll say 5 years down the road, but it's probably less than that. And this has nothing to do with COVID, frankly. This is, you conceived of what we're sitting in today long before COVID. WeWork was invented, 10 years ago. And really what that's about is flexibility, both in terms of lease term, but also how the space gets used. And this will be a recurring theme as we go through each of these sectors. Increasing what we're seeing in real estate is this convergence between goods, just providing physical space, and services. And it's like for those of you that are in the hospitality program, like this is going to be music to your ears. We're hiring people with hospitality backgrounds in all of our businesses now, because think about office 20 years ago, you would meet with the CFO, they would sign a lease for 20 years, and you'd say, I'll see you in 19.5 years and we'll talk about a renewal. And you never thought about them again. And you didn't think about which tenant was on the 16th, 17th, and 18th floor and how they might interact with other tenants in the building, or frankly, even what the retail looked like downstairs. That's all out the window now. The tenants want to understand what's happening in the precinct. They want to understand what's happening around it. And so a place like this, like Battery Park, where we have all of the surrounding residential and the other amenities, are incredibly important. For yourself and how you guys chose a location like this. But increasingly, this is what's going to differentiate the high quality asset. It's not going to be, are you 15 steps or 45 steps from Grand Central Station? It's going to be what are the services? What's the amenity package that comes in these office buildings? And for the commodity stuff, that's just an elevator and a front door. I think it's going to start.
Let's pause for a second on. So what you're alluding to is the concept that we call branded office. So in the 1950s, there were no branded hotels. There were motels, and then these people, the Statlers and the Hiltons and the Marriotts, they said, "Oh, let's have this brand called Marriott." And when someone goes to a new city, they're going to know that we stand for something, and it became the beginning of brand. But then, of course, the real estate split off from the operating companies and the brand, what have you. But for some reason, office space, this happened in retail, it happened in restaurants, mom and pop stores became chains, mom and pop restaurants became chains, but it never happened in the office building business. Now, then there was people like WeWork, and they were creating this concept of branded office experience, but they didn't really own the building. They weren't landlords. They were sublandlords. It was a little different. Brookfield has been a leader in creating branded complexes and grasping the importance of being a good landlord. Now, Brookfield's having a hard time. How many facilities like this are there in the world where you can put your name on it? And do you want to put your name on every building? But as a tenant of Brookfield and as a partner of Brookfield, we've had a tremendous experience with Brookfield. There's someone to call. You have a problem. They want to help. They have beautiful common areas. They're spending money. So Brookfield has created, whether their name's on the building, whether it's the same as another building, they've at least created a reputation of being a good landlord. So first step to being a branded concept is at least being a good landlord with a great reputation. People are willing to pay a premium to be somewhere that they have a quality landlord. But this world's morphing. Talk a little bit about where you see body counts in space and the shared office worlds that's going on, and how that relates back to Brookfield.
Right. So we sort of saw this, say, emerging in Asia and moving a little bit, but where we have not seen people returning yet. And for most of the people on the call today, they would probably think everything I just said is crazy. In a place like London, certainly Toronto, and New York, we're not there yet. It's coming, but we're not there yet. And so we ourselves have been, we've been back in the office for about a year now. We actually brought all of our people back last June as soon as we were allowed to in New York City. And we did that for two reasons. One, obviously, if we don't believe in office, nobody's going to believe in office. But two, we wanted to build a playbook for our tenants, because we knew that there's going to be a lot of things that you're going to learn along the way here. And so we now have the benefit of actually having been in the office for the last 12 months, things that work, things that didn't work, et cetera. And so when we look at our tenants, 12 months ago, none of them were thinking, if you ask them when you come back to the office, they would say, I don't know, we have no plans, there's no date fixed at all. Even the end of last year, you asked them and they said, no, don't really have any plans. In February, they would say, we don't really have a date yet, but we're starting to think about it. Sitting here now in April, they're all thinking about it. And so they don't necessarily have the dates nailed down, but everybody is trying to figure out what does it mean. I think you're starting to see this get picked up a little more in the press now. Clearly, but one of the most important things about an office, and if you go back pre-COVID, all of our tenants were talking to us about using the office as a recruiting tool, key recruiting and retention tool. This is where collaboration happens. This is where innovation happens. We need to create an environment, and again, like what you've done here, which is more than just fluorescent light bulbs and these sort of cubicles where you don't interact with others. How do we actually create places, and Google's sort of been a leader in this, where we have forced interaction between people? It's not even just that it's nice to look at, but we're actually thoughtful about what groups do we put next to one another, where do we locate the food, et cetera, and really driving that innovation. The last 12 months have been really hard because we've sent everybody home and they said, oh, Jesus, the Zoom thing works. But ultimately, all of that has to happen. That collaboration, we've lost something along the way. And I've seen it in our business. We have 2/3 of our people that are back and about 1/3 that haven't been able to return to the office because they're compromised or they have some other issue that hasn't allowed them to come back to the office. I feel like they've lost 12 months, whereas the ones that are in the office, particularly the younger people that are just starting out in their career, have a huge leg up over a lot of their peers. And so I think businesses are going to realize that we managed to get through it over the last 12 months. And maybe our business didn't completely blow up because we could communicate by Zoom. But that's no way to build a business. You can't build a brand. You can't build a culture. So people will need to come back to the office. Now, what's that going to look like? Again, like the hotel model, there's going to need to be a reason to bring people into the office. It can't just be you need to be in the office and sitting at your desk with your head down so your boss sees you there. You need to think about how to use it. And that's where a lot of people now are saying this is actually an opportunity to think about maybe we evolve the way our office works. There's every bit as good a chance they need more space, not less, in order to do that. Whether that's because you need to space people out more, or you need more common areas, et cetera. So I think it's.
So let's just play that trend out, because there's lots of, I talk to a lot of these folks that are on the Zoom call, and they want to go in the real estate industry, and I say, please pick a very narrow category, unlike Brian, pick a very narrow category of real estate that you want to get involved in, because if you spend 3 years on hotel real estate and decide you don't like it and you want to go into office real estate, you're starting back at scratch. Like, there is almost very little similarities between the business model and the relationships and the skill set that you need for different categories of real estate. But let's just stick with office for a second. So my premise, I'm hugely bullish on office space. And my premise is that there's 40 billion square feet of office space in the United States, and huge chunks of that in the suburbs. And all of it, not your buildings, all of it's obsolete, because it's not where the energy zones are. It's not where, it has center cores. It's not set up to have the type of environment that people want to spend large amounts of their time in. So over the next 20 years, it's my premise that a large amount of the 40 billion square feet of office space, maybe 20 billion of it, is going to get redone. Not necessarily the office building itself is going to get redone. This office space is going to move. My premise is that office is moving to town centers and to the malls. And that's where you're going to see, because people want to work where there's a Starbucks and there's a Lifetime Fitness. So where do you see, you've been major cities, you have other assets. So how do you see the future of office playing out?
Well, I think that's very much what I was getting at, was this idea of these live, work, play centers. Is really the future. And we've been, this is where our business has been heading for a while. So here in New York, we've got this complex, but we've also just built Manhattan West, up right across the street from Hudson Yards. And it's, 7 million square feet of office. It's retail. It's a hotel. There's a Peloton studio. There's a Whole Foods in it, and 850 apartments, all in one complex that is sort of under joint management, and so ensures everything works together. And that is when we talk to our tenants. Like I say, they want to understand what's happening inside my four walls, but also when people go outside for lunch, what are their food options? How close can they live? What's their transportation?
You call that Manhattan West, right?
Manhattan West.
Right, but you're not branding it Brookfield.
It is branded Brookfield. So there can only be one Brookfield place in New York. We thought it'd be too confusing. Right. So what we have is flagships around the world in all major cities. So New York, Toronto, now in Sydney, in Perth, in Calgary, Dubai. We have a Brookfield place, and that's the flagship for that location. But all of the buildings are flagged, as a Brookfield building, and we have tried to build that brand as a, you know what you're getting in a Brookfield building, and it's helped out tremendously because, again, if you think about the tenants we've got, they're global. JP Morgan, they're leasing space from us in 6 countries around the world, and so when they are looking for space in India, and all of the decisions all end up in the same place, and they say there's 5 guys that that we've never dealt with in the past, or we have space with Brookfield, you get it. And so, your question about other cities, I think that urban environment can translate to a lot of places. Like, obviously, it works well in New York because this is an urban environment. But increasingly, you look at a place like, say, Nashville or even Charleston, where it doesn't necessarily have to be in a 10 million person city for it to feel like an urban environment, which is a little more density, more entertainment, food and beverage options around it, and something interesting to do, as opposed to the sort of 1980s office complex, which was a huge campus in the suburbs with a parking lot and nothing else.
So you're bullish on office?
Yes.
Okay. So let's chill just before we switch categories. Let's just talk a little bit about New York. So you and I have spent a lot of time. So how many people are normally occupy this $5 billion asset here?
It's around there.
So 50,000 people are normally here. Now it's Brian and I. We wave across the hall. There's literally, it's starting to pick up this week. Literally no one here for a year, but like Brian and 20 guys and me and a couple people and whatever. So what's going to give us all your prediction on New York? Is New York going to come back? At what pace? What's going to happen in New York?
Yeah, it's going to come back. It's going to take time. And I think if you look at the pace of the rollout of the vaccine, et cetera, all of that is pointing toward, a big reopening over the course of this summer. And so we're sort of anticipating from talking to tenants that we will be today, the true occupancy of the buildings here on a daily basis, somewhere between 15 and 20%. And that's up a long way from where it was. By the start of the summer, we think that'll probably be closer to 40. So I think it's gonna feel busier by then, but it's really gonna be post Labor Day before we're back at that 60, 70%.
Do you have any idea what your volume to your retail people in this facility? Are they back 10% or 40, 20%?
Well, the luxury retail actually is I won't say fully back to normal, but their numbers are pretty good. The food and beverage, obviously, which is driven a lot during the day by office workers, is still at about 30, 40%.
Okay, so September, October, November, we're talking city's back, and then what is it going to go? I mean, it was on fire 2019. I mean, Amazon bought the Lord and Taylor building. Google began construction of this massive thing. Apple made a deal. Wherever, Facebook made a deal. I mean, it was the most unbelievable year ever, maybe in the history of New York in 2019. Are we going back to that, or what are we going back to?
Yeah. I mean, with the last 12 months, we hit a brick wall. So it's not like in past downturns like in 08 or even the early 2000s where you had some sort of an issue with the real estate market. We were building too much stuff, or it didn't make sense where we were building it, et cetera. This was entirely external to that. And I think just like you're going to see the market recover, all these businesses and the guys who you just named have all been continued to gobble up space even through the pandemic.
Okay, so for a moment, so for everyone watching us, so I totally agree with you. I think New York office is going to be booming, and I'm not an office guy. I don't know any office, minimal office buildings. Like I'm very different than Brian. I think it's going to be booming. So everyone take a note for next year's session, because you're not hearing a lot of people say what Brian and I are saying. The traditional word out there is, oh my God, office space in New York City is not going to be strong, but we disagree with that. All right, let's change to retail. So you have a humongous retail platform because you had one and then you bought GGP. Tell us a little bit about that, but tell us, what is your solution at the mall?
Yeah, so again, same sort of approach. Like over the last 12 months, unlike office, the tenants in our retail business, their businesses have been hugely disrupted, meaning many of them have been unable to pay their rent. And so we've seen real economic losses in terms of uncollectible rent and bankruptcies and store closures and all the things people have read about it. So the solution there is not quite as simple as office, which is everybody will come back. We had long-term leases and they paid all the way through. We have always looked at our portfolio and said within that portfolio, as with most portfolios, 80% of the value is in 20% of the assets. And that continues to be true today. And that 20% of the assets, I'm not worried about longer term. In the short term, there's issues with some of the tenants that need to be worked through, et cetera, but these are enormous centers that are well located in sort of fortress-like locations. I'll come back to what the future looks like for them, but they're going to be okay. The other 80% of the industry, which is maybe 20% of the value, but a very large number of them, there's going to be huge disruption. And COVID accelerated this, but it's been there for the last decade, right? And it's really just the increased adoption of online retail, et cetera, has sort of driven a lot of that. So I think for those, again, within that 20%, there's a category of malls that are in good locations. They just shouldn't be a mall, or they shouldn't have as much retail square footage, and there's higher and better uses, whether that's residential or other things, and they'll get converted over time. Sometimes you need a value adjustment before the economics of that conversion can work, and I think that's what we're going to see is an acceleration of that consolidation. Now, if you are the survivor on the other side of that, consolidation is a good thing once it's over. So I think there will be a smaller number of centers, and just like we described with office, there has to be a reason for people to go, right? Like if you just want to buy a white T-shirt, you don't need to go to the mall anymore. You can have it delivered this afternoon by 15 different retailers, and that's no longer a reason to go there. But there's experiences, there is social interaction, there's retailers like Saks where it's more than just the goods you guys are selling. It's the whole experience, and there continues to be a need for that physical storefront to do that. In addition to it acting as a fulfillment center. So if you look at the retailers that actually perform well through the downturn, Target, Best Buy, Walmart, all these guys have enormous real estate footprints, and none of them are talking about really shrinking that. In fact, they look at it as it was a key competitive advantage for them in having that network of stores. So it's going to change dramatically. I think, again, like office, the idea that, look, there's not going to be any more physical retail and we're just going to buy everything online, I don't think that's right. But certainly we have been under demolished in the retail sector in this country for a long time. And there's some older 1960s.
Just stick with that concept. So malls is a tale of two cities. So under demolished is a great way of saying it. So there's a large number, 50% of all malls should just go away. It has nothing to do with, Brian doesn't own any of them. And if he owns any of them, they're on his books for nothing. So he doesn't live in that world. All he cares about are these A malls, and then how do we make those A malls better? So talk a little bit about, you doubled down, tripled down on GGP, and that you've built a development team that's huge. And what are you doing with those malls?
So just like with office, where we've looked at the retail and said, what can we do better with the retail to make the office more attractive? Similarly, when you've got a predominantly retail center, we've said, what other asset classes could we bring in? And residential is the easy one, right? Like, it's in a place like California, where you've got a chronic housing shortage, a challenging entitlement process. What we own are 175 development sites around this country that are generally in densely populated urban areas. And so when we go in front of a town council and say we would like approval to build 300 apartments, and all we're really going to do is take this mall that's no longer that attractive in a parking lot and turn it into something that's going to bring an increased tax base into their city. It's a wide open door, as opposed to the developers coming in saying, I want to build apartments on this greenfield site over here. And so for that reason, we've got a low base.
So major communities in North America, there's a loop road, the mall's in the middle of the loop road, and the communities want development inside the loop road, and they're happy to let you go dense and go at it inside the loop road.
Yeah, happy is maybe a strong word, but happier than it certainly makes it easier. And so it's not an easy process, but it is, there is that opportunity there. And it doesn't work everywhere. So there are, again, as you said, there's these 500 malls that are probably going to go away. It's not a solution for all of them. In fact, ironically, where it works best is on our best malls. But if you think about it, that makes sense, because they're our best malls because they're well located. So like Ala Moana Shopping Center, which is one of the highest productivity malls in the world, fantastic residential development opportunity there, because
I got a great idea for you. That Neiman Marcus, you should scrape it and put a big apartment tower there.
Right. And so it's not always a solution for a dying mall. Oftentimes it's just an enhancement for a high quality.
Right. Okay.
And that's where a lot of our efforts are.
Right. That makes sense. Okay, so let's pivot to third major asset class for you is residential. So give us a little flavor and where you see that going.
So when you say residential, we're in two types of residential. There's the for sale housing business and then the for rent multifamily. For rent multifamily is closer to our other businesses because these are assets we own over long periods of time and you're releasing them. And so outside of New York and San Francisco, those businesses stayed resilient through the downturn. Clearly, stimulus checks and enhanced unemployment benefits, et cetera, allowed people to keep paying their rent. In New York City, everybody left, and so it was a little more challenging. Although I will say at Manhattan West, where we have 850 apartments, that pre-pandemic we were at about 90% occupancy. It dipped as low as 70, and today we're back in the 90s.
It's coming back. It's coming back. My son said he was offered was looking at an apartment to rent, Lower Manhattan, offered them the ask, and they said, sorry, we have 50 people coming for a showing. So this is changing rapidly.
And February was a record month for rentals as well as sales in the city. So I think that just goes back to what we're saying about office. Like, people are coming back; they just have not been in possible.
Okay, so, and we're going to open it up for questions in a minute, but so your feeling here is that in the next couple of months, as the pandemic ends in the United States for a moment, Canada's different and Europe's different, but in the United States, sounds like you're, game on. 2019 just keeps going. We lost 18 months or whatever it is, and off to the races.
Well, and it's probably not a perfect analogy for it, but a big part of our business is buying new stuff. We've got these funds with dry powder, and we have a significant amount of capital that we're looking to put to work. We are finding it very challenging to find things to buy at reasonable values because it is so very competitive out there. So even things that we didn't talk about hotels, but clearly, like when you think about operational distress, hotels are.
You should be able to buy hotels for a song today. They've been empty for a year, and they're all getting foreclosed on. So what's the story with hotels?
Prices are higher today than they were pre-pandemic. A lot of it has to do with debt markets. So debt capital markets are wide open and available for hotel buyers, and we're seeing hotels now price.
So what's happening? So lots of people are going to lose their hotel to their lender?
I'm not suggesting that's necessarily a good investment, but it is. But it certainly does mean that there is a lot of confidence out there in the economy, and B, a lot of capital that is looking to invest in this. And I think it'll when things do reopen, hotels are going to be an amazing place to be. Everybody wants to get back out, get traveling again. They're going to fill back up. And capital is looking at it and saying, we can ride this out for 3 months because I can see what's on the other side.
Yeah, I think that's absolutely right. So, all right. So very bullish, very exciting future, according to Brian. I think, Brian and I chat all the time, through the darkest of ugly days. But I think we're pretty much both in agreement as to where the world's going. Let's open it up to see if there's any questions out there.
So the first question is for Brian. Do you think that office will continue to be a stable asset class in big city, suburban, secondary cities, and tertiary cities?
Yeah, so, look, I think, as I said before, pre-pandemic, everybody would have agreed that primary cities like New York, San Francisco, that's a fantastic place to be in office. And the reason for that is if you're Google or you're Facebook or you're Amazon and you're looking to hire a very large number of talented, intelligent, recently graduated young people, you got to go where the people are. And so we're seeing a little bit of migration within the U.S. into some of these smaller cities, but the idea that you're going to move your business to Miami, let's say, and have the same talent pool to dip into that you had when you were in New York City is just
from Miami. I'm totally with you. Everyone I know has moved to Miami or Palm Beach, but they're going to have to come back.
They'll have to come back, and so I think for that reason, New York's New York for a reason. This is an exciting place. If you're 26 years old, you should be moving to New York City right now. Your son missed his opportunity to get that apartment, but I think this is what we see each time there is one of these downturns is, you get this huge rush of people who it was maybe unaffordable for them to come here, and you're going to see a whole new crop of people, and then the companies follow and they say that's who we want to hire, and then those workers want to live in an exciting place like this. So I think there'll be a little bit of migration, but I don't think the idea that businesses can pick up from New York and replicate what they have here in these secondary cities is really going to happen. So might some people have some secondary locations? Might they have some roles that don't necessarily need to be in the office because they were, support type roles that didn't interact? Sure, we could see that, but I don't think it really changes the story for a primary city.
All right, thank you, Brian. Cody, you have another question?
Yes. The next question is for Brian again. What's your view on the real estate market in India, and what opportunities do you see in the future?
Sorry, you broke up. Where, in India?
Yes, India.
Yeah, India is an exciting place. So we have now been there for about 12 years and have built up a pretty sizable office business there. I think we're the largest or the second largest office owner in India. It's a challenging place for someone to manage remotely or to run a business.
Where in India are you?
primarily Mumbai, Delhi.
Just rented a big chunk of space in Mumbai. I don't know why we didn't do it with you.
We should talk. We'll come back to that. So look, it's a very young, highly educated population, tremendous demographics. It has while it is sometimes a challenging place to do business, it has the distinct advantage that it is based on British common law. And so therefore there are contracts, there are courts that work, the laws are enforceable. There's a sound respect for private capital. And those are all the things that we look for in an emerging market. So, it'll certainly be more volatile than investing in the UK or Canada or Australia. But we do think there's a lot of great opportunities there, as this middle class just explodes. And so I think things like retail, we're here, we look at it and say we're under demolished, and they're undersupplied in terms of physical, even though they're going to, jump leaps and bounds ahead on e-commerce and get to a place for much sooner than we had. They're still undersupplied on that. So I think there's a tremendous opportunity to do.
Cody, next question.
Next question is, how will urban unrest impact the return to Center City?
Well, look, it's certainly a concern, and I think there's a few things that I would put into the same category, which I'll say is the offset to all of the excitement Richard and I have about people wanting to return to New York City. Is one of the great things. I moved here in 2013. And for me, one of the great things about moving to the city was for a city of this size, it felt safe. You felt welcome here. It sort of, it was an open place where, you felt like you could fit in pretty quickly. I think when you end up with environments where, either you've got social unrest, you've got safety concerns, or frankly, you have political concerns where, it's like, let's tax everybody who has a job and chase them out of town and vilify them. Those are not positives. And so I'm hopeful that as things emerge and as people get back out and start to do that some of those things reverse here in New York, because that would definitely have a drag or a negative impact on returns, on the desirability of wanting to be here. But I am hopeful. New York has been there before, and I think there's enough people around here that are now focused on ensuring we kind of get back to that place where it is a vibrant, exciting neighborhood again, as opposed to less desirable. I think we're going to be all right.
Next question is, as online retail and Zoom office becomes more a part of our lives, how do you see the crossover of experiential retail and community-centric office of the future overlapping? Is the space you are sitting in a trend you are seeing in your other properties?
Cody, I think I missed the end of it.
Say the end of it. We're having a hard time hearing you on the last piece.
It said, is the space you are sitting in a trend you are seeing in your other properties?
Yeah, definitely. So that, this idea of experiential real estate, and as I said, the sort of hotel-like mentality seeping into all of our buildings, and whether that's retail where it's much more customer focused than maybe it's been in the past. Certainly with office, residential, same thing. All the amenities that are happening in our residential apartment buildings. And that's really what's going to distinguish good real estate from bad real estate, as much as the specific location. So I think that is a trend that's going to accelerate. I think all of us are scrambling to catch up. I think technology plays a huge part in that. So if you think about what Tesla has done to the car, when you get in a Tesla car now, the things this thing can do are incredible. But now if you look at every other car, they're all trying to catch up to, whether it's adaptive cruise control or some of these other things. You're going to see the same thing with buildings, which is buildings getting smarter, allowing either a landlord or the tenant user to adapt how the building is used, or have the technology enable different things happening inside.
So Brian brings up a good point. So, for example, we're sitting in what was formerly a retail space, and that was designated in a very complex building with a very complex landlord to be retail. We came up with this new concept, which is retail office. You can get a membership by the hour here. You can get the membership by the day, by the month. Is it retail? Is it office? And we've worked with Brookfield, for example, in order to figure out how to, circumvent all of the traditional ways of thinking in order to create new types of retail and new types of office experiences. And it's early days. People are reinventing and reimagining how space gets used and how much technology and how much brick and mortar type retail will be there. It's, we're all playing. Maybe one more question, Cody?
Sure. This last one is for you, Richard. Any redevelopment plans for the Canadian Hudson Bay properties?
So let's see. So we have about 99 Hudson Bay stores in Canada, and we have no plan. I think we closed one maybe in the last year. We have no plans to close any more, but we do have the opportunity to tighten up some of those buildings, making it up in a place like Vancouver, where we could take the top 2 floors and launch a Saks Works in those top 2 floors, or in a place like Toronto, where we have excess space. And part of our ecosystem going forward for our different brands is we think of the world as 5 separate pillars in retail land. Real estate that we own, brick and mortar stores that we operate, and the brick and mortar stores we own, you can finance, you can, they're worth whatever they're worth, you can buy them, you can sell them. The brick and mortar stores, they should make some money. We're going to keep that as a private company, and they provide a great service to our customers. The third pillar is Saks Works, and being able to shrink some of our space into other additive, productive kind of space. The third pillar is our intellectual property, the ability to borrow against it, the ability to brand other businesses, Saks Works, for example. And then the fifth pillar is our .com businesses, which are getting rewarded based on market share. So if we can operate those 5 pillars so that our customer has the ability to enjoy our ecosystem, but we have the ability to properly fund and capitalize each of those different categories, that's sort of our road forward, and that's how we're thinking about Hudson Bay and Canada going forward. All right, I think any last, we good on time, or we want to do one more? How do we close it out, Cody?
I'm going to close it out. So on behalf of me, Alyssa, and everyone in the Baker program, we want to thank both of you for taking time out of your day to speak with us. And Richard, we want to thank you for your ongoing support of the Baker program. So that's all we have, and thank you so much for
our pleasure. Our pleasure. Thanks, everyone. Next year in person. And Brian's offered to offer to be one of the sponsors next year. Thanks, Brian. Okay, guys. Bye-bye.